Seeing a lot of back and forth in 2025. JP Morgan's now predicting 2026 may start off slow, but then improve later in the year. Now, the bank.
The American economy has grown at a pace that surprised just about everyone, 4.3%. That kind of growth usually makes investors want to celebrate, but instead, stocks actually dipped for a bit. It seemed backwards, celebrating less when the news was good. But the reason tells a fascinating story about what might be coming in 2026. That strong growth number meant the people in charge of interest rates probably would not cut them anytime soon, and without those cuts, some investors got nervous. But beneath that surface reaction, something bigger was happening. That single report gave a powerful boost to an idea that has been quietly spreading through the biggest banks and investment firms in the country. They have a name for it now. They call it "Run It Hot." Sitting down to plan for the year ahead often means looking at where to put money so it can grow. The news is full of confusing terms and conflicting advice, making it hard to know what to do. But sometimes, a clear picture starts to form from all the noise. Right now, that picture looks like an economy running warm. Not too hot, not too cold, but just at a temperature where certain things really start to bloom. This is the story Wall Street is telling about 2026, and understanding it can make the path forward much clearer. Here is where the story gets interesting for anyone thinking about investing. That blockbuster report gave a huge boost to an idea that has been quietly building among the big banks and investment firms. They call it "Run It Hot." Think of it like this. For years, there was a constant fear that the economy might stall, like a car sputtering at a stoplight. Now the fear is flipping. Instead of worrying about a stall, the question becomes, can the engine handle the heat? Can it keep running at this higher speed without overheating? The GDP report was proof that, at least for now, the engine can handle it. So, what is causing this hot engine? It is not just one thing, but several forces working together. Think of them as different fuels feeding the fire. There are new policies around taxes and trade that are designed to encourage business. There are shifts in the job market with people finding new kinds of work. There is the ongoing explosion of artificial intelligence, which is making companies more productive, meaning they can do more with less. And there is talk of cutting back on regulations, which can make it easier for businesses to expand. One expert quoted in the report put it simply, saying all these factors together point to a year of above-trend growth. Another expert warned that if the economy keeps pumping out numbers like this, everyone's focus will completely shift away from worrying about a slowdown and instead flip back to worrying about prices getting too high too fast. This phrase, "Run it hot," was actually first used by a major bank back in September of 2025, and since then, it has caught on like wildfire. One team of analysts even wrote a note that summed it up with a punchy rhythm, saying tariff cuts, tax cuts, and rate cuts all point to a run-it-hot policy. They even suggested that the stock market itself feels like it has an invisible safety net, as if it is simply too big to fail. Another major firm, Morgan Stanley, built its whole investment thesis for the year around this concept, pointing to the Fed's actions. And Goldman Sachs chimed in, noting that even though job growth might not be exploding, the rate cuts from the Fed should protect the job market and keep the economic cycle going for longer, even if stock prices already look a bit pricey. Okay, the economy is running hot. That sounds good. But what does that actually mean for a person's money? Where does it make sense to have investments placed when the economic weather is like this? That is exactly the question the big banks are trying to answer, and they have some specific ideas. The first and most important recommendation from Bank of America is to look at commodities. Commodities are the basic materials the world runs on, things like oil, copper, wood, and wheat. When an economy runs hot, it needs more fuel and more building materials. Factories hum, construction projects break ground, and people travel. This demand pushes up the prices of these raw goods. Bank of America's strategists were very clear. They said that if there was one single trade to make in 2026, the best one would be to own commodities. They specifically pointed to oil and energy companies as the best contrarian play. A contrarian play means going against what most people are doing. Many investors have shunned oil and gas in recent years, but in a hot economy, energy is the fuel that keeps everything moving. The strategists painted a vivid picture, suggesting that soon, the price charts for many commodities, from oil to metals, might all start looking like the steady upward climb of gold. This naturally leads to another question. If commodities are the fuel, then what parts of the stock market itself are most likely to benefit? That is where the idea of cyclical investments comes in. Cyclical simply means that something goes up and down with the economy. When the economy is expanding, cyclical companies thrive. When it contracts, they struggle. Goldman Sachs believes that cyclical assets are the place to be. They pointed specifically to two areas. One is housing. When people feel good about their jobs and their financial future, they are more likely to buy a new home. That means business for home builders, lumber companies, and furniture stores. The other area is the consumer-facing side of the market. This includes what are called consumer discretionary stocks. These are companies that sell things people want, but do not necessarily need. Think of restaurants, travel companies, clothing brands, and electronics. When people have extra money in their pockets, they spend it on these kinds of experiences and goods. Goldman noted that even though these types of stocks had already started to rally, their more optimistic view on growth was probably not yet fully reflected in the stock prices, meaning there could still be room to run. This focus on consumer spending is echoed by Morgan Stanley, which also likes consumer discretionary goods. They have a specific reason for this, though. They point out that many companies today have something called pricing power. Pricing power means a company can raise its prices without losing too many customers. In a hot economy with inflation, this is a superpower. If a company can charge more for its products, its revenue, the money coming in the door, can grow much faster. Morgan Stanley's analysts looked at the numbers and saw that this was already happening. So, we have commodities for the raw materials and consumer companies for the spending spree. But there is one more piece of the puzzle that multiple banks agree on, and it is a part of the market that often gets overlooked. That piece is small cap stocks. Small cap refers to companies with a relatively small total value, usually between a few $100 million and a couple of $1 billion. These are not the giant, famous names everyone knows. They are the smaller, more agile companies, the ones that might be the next big thing. Morgan Stanley laid out a very clear case for them. They said that for small companies, two things are about to happen. First, they are starting to see positive operating leverage, which is a fancy way of saying that as they sell more, their profits grow even faster. Second, they have pricing power, just like the bigger consumer companies. This combination, more sales and the ability to charge higher prices, is especially powerful for small companies and should fuel a strong recovery in their earnings. Bank of America and Goldman Sachs are on board with this idea too. Their reason is a bit different, but just as important. They point out that for years, all the attention and all the money has flowed into the biggest tech stocks, the so-called mega-cap names. As a result, those stocks have become very expensive,